What if I told you that while you're celebrating your diversified 60/40 portfolio, the smartest money in the world is quietly building wealth in a $33 trillion universe you've probably never heard of? Hey everyone, I'm David Warshaw, certified financial planner at the Wealth Plan LLC. And be sure to stick around because I'm going to walk you through the exact screening process that I use to vet alternative investments, including the must-have criteria that I use to build an all-star lineup for my clients. So what exactly are we talking about here? Alternative investments are everything that's not stocks, bonds, or cash. As of 2025, this universe has exploded to over $33 trillion. That's roughly 15% of all global assets under management. We're not talking about some niche corner of finance anymore. This is bigger than the entire GDP of the United States. Okay, let me introduce you to the 5 biggest players in the space. Number 1, private equity, currently worth about $11.7 trillion. This is the absolute king, representing 35% of the entire alternative space. That's bigger than Japan's entire economy. This is where you invest in private companies before they go public. Can you imagine if you could have invested in Google, Facebook, or Amazon before they went public versus buying the stock after everybody already knew about it? That's private equity. Number 2, real estate, currently worth $7.1 trillion, about 21% of the alternative space. This isn't just single-family homes. We're talking about commercial buildings, property funds, REITs, the entire real estate ecosystem. Number 3, hedge funds, currently worth $5.5 trillion, about 16% of the market. These are the chess masters of investing, using sophisticated trading strategies like merger arbitrage, managed futures, and global macro trading, just to name a few. Number 4, digital assets, currently worth $3.9 trillion, or 12% of alternatives. This includes a myriad of different cryptocurrencies and stablecoins. This space is growing faster than everything else combined. Number 5, infrastructure, currently worth $1.7 trillion, or 5% of the alternatives category. These are roads, energy grids, data centers, the investments that literally keep your lights on and your internet running. Now, there are some other categories definitely worth knowing about. Private credit is currently at $1.5 trillion. Commodities like gold and oil are at $1.3 trillion. And the art and collectibles market is currently at $598 billion. All right, now that you know the landscape, the obvious question is, why should you care? Let me give you the top 5 game-changing benefits. Number 1 is true diversification. When stocks crash, alternatives might be partying. They often move completely independent of public markets. 2, early access advantage. Here's what most people don't realize. By the time a company goes public, the best growth is often over. Alternatives get you in before everyone else knows the party is happening. 3, inflation protection. Real assets like real estate and commodities actually benefit when prices rise. Your purchasing power stays protected even while your cash is currently getting destroyed. 4, moonshot potential. While most of your portfolio is delivering steady Eddie returns, it only takes one winner to transform everything. Think about the potential of finding the next Google before it goes public. Can someone say Lambo? And number 5, enhanced income streams. Infrastructure and private credit can generate steady income, typically in the range of 5 to 10%. That often beats traditional bonds by a wide margin. Plus, certain structures may offer tax advantages like depreciation benefits in real estate or intangible drilling cost deductions in oil and gas investments. Of course, speak with a tax advisor before you invest. Now, before you get too excited, let me bring you back to reality. Alternatives do come with some serious challenges that could hurt you badly if you're not prepared. Like risk number 1, liquidity. Unlike publicly traded stocks or bonds, which you can sell instantly, alternatives can lock up your money for 3, 5, or even 10 years. Some have 0 secondary markets, meaning you're trapped until the fund decides to let you out. Here's my question for you. Could you really stomach locking up $100,000 for an entire decade? 2, fees will eat into your returns. Alternatives are not your plain vanilla index funds. They could charge you 1 to 2% management fees plus 20% performance fees. On a $100,000 investment, you could be paying $2,000 a year just in management fees, and that's before any performance fees are factored in. Number 3, complexity and valuation opacity. Unlike stocks with real-time pricing, alternatives rely on third-party appraisals and in-house sponsor estimates. You're often flying blind on what your investments is actually worth, and due diligence becomes absolutely critical before you invest a single dollar. 4. Limited access and higher minimums. Most alternatives require you to be an accredited investor. Well, what's an accredited investor? Either someone that has $200,000 annual income for 2 years or $300,000 for joint filers, $1 million net worth, excluding your personal residence, or hold specific professional licenses. The SEC is basically saying, hey, prove to me that you can handle this risk before we let you in. And even if you qualify, many funds can have minimums in the range of $100,000 or even higher. And lastly, number 5, manager selection is critical. Here's the brutal truth. In alternatives, the difference between the top and bottom performers is enormous. Most managers can actually underperform, and picking winners is extremely difficult. You can't just buy an index fund here. Choosing the wrong manager and you could underperform for a decade while your money is locked up. Now, at this point, you may be wondering, well, who's actually using these alternatives? Well, believe it or not, over 90% of financial advisors now use alternatives, and assets have tripled since 2016. And here's what's really interesting. Alternatives may be coming soon to your 401k plan starting later in 2025, thanks to recent regulatory changes. Currently, major institutions hold about 38% in alternative investments. University endowments hold about 35 to 50% in alternatives. And ultra-high net worth individuals hold around 30% in alternatives. Now, as I promised in the beginning of the video, let me share exactly how I evaluate alternatives for my real clients with their real money. I primarily utilize evergreen interval funds through Schwab, which is my primary custodian. Why these? They provide quarterly liquidity, they fit in IRAs or brokerage accounts, offer immediate diversification, and issue simple 1099 tax forms instead of more complicated K-1s. My screening criteria include a minimum 3-year track record. I want to see how the fund is done, as I just don't trust most new funds. I want to see $100 million in assets in the fund, run by a sponsor who's managing more than $1 billion in assets. These criteria help ensure operational stability, institutional backing, and regulatory scrutiny. Gives me the warm fuzzies. I also ask all the different sponsors who are their leading competitors, because I want to see who the top people in the space are. Once you've asked a private equity sponsor to name their top 3 competitors, and you do this 20 times, you get a sense of who's the top tier managers. Beyond these basics, I analyze fee structures to see who's competitive, review detailed investment materials, and carefully examine redemption terms. Most common question, how much should you allocate to alternatives? Well, I generally recommend 10 to 30%, depending on your individual risk tolerance, time horizon, and liquidity needs. Remember, alternatives are a complement, not a replacement to a traditional portfolio. Look, alternatives can provide valuable diversification and return potential, but they're not magic. They require careful selection, proper due diligence, and realistic expectations. Before you invest a single dollar, ensure that you have an adequate allocation to traditional assets, understand exactly what you're buying and the risks involved, be sure that you can afford to lock up capital for years, and most importantly, work with an advisor who has real experience and specializes in this space. If you found this video helpful, do me a favor and hit that subscribe button so you don't miss out on future videos. And drop a comment telling me which alternative category you'd like me to cover next. I read every single one. And if you want to see a deep dive on one of my favorite private equity alternative investments, check out this video where I break down the AMG Pantheon Fund. Take care. Bye-bye.